Hello and welcome to Shape the System, where we find and tell the stories that help people to rethink the way the world works. We interview people from all over the world who are helping to change our systems for the better. Shape the System is an independent podcast with support from KPMG High Growth Ventures, who help ambitious founders and their teams scale up for success. More about KPMG High Growth Ventures after the interview. We hope you enjoy this episode.
Hi everyone, welcome again to Shape the System. I'm having a chat to Camille today about Bloom. Give me your surname, by the way, Socquet-Clerc.
Socquet-Clerc.
Oh, it's pretty close. Always indeed. We're going to talk about Bloom investing a little bit later on. What we're going to do first is just dive, as we always do, straight into the problem space in which Bloom actually operates in. And normally I would have a crack and say, here's where I think you guys play. But I actually think there's a few macros at play here. So, Camille, if you're okay, I might just leave you to firstly land us in the space and then we can dive down some rabbit holes.
Okay, let's do this. So, Bloom operates in a very interesting intersection between finance and sustainability. And the big macro environment we play in is sustainable finance. So, everything that has to do with how to utilize capital and the markets, private and public, to drive the clean energy transition.
Mm-hmm. Okay.
Does that paint a picture?
Yeah, absolutely. And so, as I said, we'll always go into rabbit holes. This is one of the fun parts of the show. I'm going to ask, probably going to get annoying eventually with asking this, but okay, so when people tend to think about sort of energy and kind of sustainable finance, I think there's probably kind of a few things that sort of pop up. People think about how they might be directly involved in sustainable energy, so putting solar on their roof or getting a battery or something along those lines. The finance angle of that, they might think about green loans. But I think most of us in our day-to-day don't get up and think about the other half of the picture, which is driving a lot of the shift to renewables, which is these large-scale projects, if you like. So I wanted to understand a little bit more about what the other part that a lot of the residential customers and the day-to-day person on the street doesn't think about in terms of the energy side of the equation initially.
Okay, I think we need to take a step back and think in terms of almost Russian dolls.
Okay, great.
To answer this question. So the first big problem is what I call the climate finance gap.
Right.
So today, the IPCC report tells us that we need to increase our investments towards climate solutions sevenfold.
Okay.
Just to modernize our energy system globally. Again, the IPCC estimates that we need to invest annually 2.5 trillion in US dollars.
Okay.
To have a small chance to comply with the Paris. I'm not even talking about a beautiful future here. We're just talking about maintaining our 1.5 degree warming trajectory. Right. And so this is the first thing. We are not investing enough. Money needs to move.
Right.
The second big issue is the accessibility. So there is a huge shift in investments from fossil fuel to green energies, let's call them this way, or
Sure.
climate solutions if you wish. It's already underway. It's just not going fast enough. And in my view, it is not taking people on the journey.
Right.
And what I mean by this is mainly today, people investing in clean energy projects. I'm talking solar farms, recycling facilities, institutional investors,
right.
Which is fine because you need big amounts. We're talking about big liquid investments. Of course,
Right.
It's not the mom and dads that will move the needle on this.
Right.
But the problem here is who will benefit from this new wealth?
Right.
Is it big institutions or will Australian people and local communities benefit from this shift? And the last system issue is on the individual level. So for a long time, we have unfortunately put the responsibility onto individuals to decarbonize their carbon footprint.
Right.
The carbon footprint is a very interesting concept when you think about it. Because
Sure.
it's essentially a way to put the guilt onto individuals, right?
Sure.
And
yes.
I mean, it's a great tool to make people realize that, yes, they do have a carbon footprint, they do have an impact, and we need to be careful. But the problem with that is we end up with a system where people think they are making a great impact by recycling and using a keep cup.
Right.
And I'm not saying that these things are wrong. They are really important. But the reality is that the single most important thing a person can do to make a positive climate impact is often looking at how they use their finance.
Right.
And when I say finance, I mean their super, their banking, and their investments.
Yeah. Right. And I want to drill into a couple of things in this. So firstly, I understand this idea that we're not going to solve the climate challenges that we have simply by deploying solar to everyone's roof and putting a battery in everyone's house, right? The idea that there is grid scale capability required. Now, that isn't just grid scale for energy, but we have large centralized manufacturing. We talked to Pratik from Pluto Shift a couple of weeks ago, and similar problem, right? He said you can go and solve all these individual problems. If you don't solve kind of the 1,000 factories that use a huge amount of water, it's going to be a problem. But I'm interested in this idea of a kind of an investment class asset, because I think people are starting to become aware of this idea of their investments have choices, right? So where you have your super, and we spoke to Simon Sheik from Future Super way back a couple of years ago, who's been pushing hard with all this stuff. But what I'm interested in is this idea that there is a whole bunch of infrastructure that needs to be built, and at the moment we're relying on essentially the combination of government policy and private money to fund this infrastructure. And to your point, there's a 7x funding gap here. Are you suggesting that there is a opportunity, and not even an opportunity, but a necessity for retail investors to fill or partially fill that funding gap? Is that kind of, if I have to try and land, is that kind of where we're at?
Let me unpack this, because this is such a great question. I don't think mom and dads necessarily need or have to fill this gap. Right. I think policy needs to change, but we're talking about systemic change here in this show. Right. So I think the flow-on effect on people shifting their money towards green options is huge and massive. And when you look at the amount of money sitting today in self-managed super funds, for example, 882 billion in assets, if I'm not mistaken, that's the ATO figure, by people who have self-managed super funds in Australia.
Right. Just Australia, just self-managed super.
Just Australia, just self-managed super fund. I'm not even talking about retail superannuation, which I suspect most people listening will have. And I do have my super is with Future Super. So that's a retail super fund. Right. Trillions are sitting in the not in the retail super. Sure. So if we start shifting this money, if consumers start preferring green options, an entire industry transforms and money start moving from one thing to the next. Right. And this is where the big impact comes. And this is where I think retail investing can make a big impact. Does that make sense?
Yeah, absolutely. I think the thing that it kind of becomes hard to kind of grasp is this idea of, if I put my money, say, into Future Super, to use your example, then they go and invest in companies that don't do bad things. Okay, well, how has that actually pushed us forward? Yeah, great. Well, that means less capital is flowing to things that we don't want. But it still feels a step short of, there is a solar farm of 200 gigawatts. That might be a bit large, but there's a large solar farm being built in Goulburn in central New South Wales, example made up, and it needs 140 million worth of funding. And at the moment, the options are for it to get it from private investors or to institutional investors, and funding actual infrastructure development as opposed to simply putting my money into companies. It feels like a disconnect in the first, but the second is actually like to your point, is bringing people on the journey with line of sight to your funding. This 17,000 that you pulled out of your self-managed super is actively funding
totally
an actual solar farm. Is that kind of the connect here?
Absolutely. So this is essentially a definition of impact investing. Impact investing is delivering an additional impact that would have not happened without your investment. When you do invest in Tesla, it's great, but would your couple of hundreds or thousands, have you actually made a huge difference? I don't know. But when you start investing in a shovel-ready wind farm, this is where the additional impact happens. So I agree with you. Right. And so any investment that shifts capital towards this new project and new additional impact will be in the impact investing category for me. And Future Super is a great example. They do absolutely do that. They have, in fact, done a very interesting impact report in 2020, and they have calculated that when you shift your super balance, I think they use 32 grand as an example, compared to a fund that would not exclude fossil fuel. They've calculated that the impact was 5.8 tons of carbon emissions that you were able to save.
Right.
So this gives you an order of magnitude, I think.
Got it. And yeah, because I think the thing that is hard for people to kind of grasp is when they can't connect the dots, right? So let's say you go and buy an ETF and it's a green ETF and it's like, well, these companies are good. You're like, cool, but how do I relate that back to, without having to go and do a study that's commissioned by McKinsey or whoever, how do I actually relate that back to? As opposed to use your example, as a shovel-ready wind farm that's sitting there, I know that it needs $1 million worth of funding. And if I put in the 32,000, then 3.2% of that wind farm, environmental impact was actually directed from my investment.
Absolutely.
So that feels far more connected to the outcome than the prior example.
Totally.
Right? Does that also accelerate the actual investment that is required to do these things?
Yeah, absolutely. And I think, but to go back to the equity question, so the question is, are we really making an impact when we invest in listed companies that are green and offering climate solutions?
That is absolutely the question.
Yeah, I think I would say a small yes, but a confident yes.
Okay.
Because what we need is to transform the system, and we need a system where climate solutions and companies offering genuine and scientifically sound solution win in the market.
Right.
And to win in the market, you need a solid investor base. So I think when you support, as an investor, as a shareholder, a company like Cleanaway Waste Management, like Sims, big Australian companies that do the right thing and are leading their own vertical of climate solution, I think you are definitely helping. And your money is better sitting there versus a BHP or somewhere else. Unless you are an active shareholder and if you go to shareholder meetings and you make your voice heard and you push for sustainability, which I doubt many people have the time and luxury to do.
Yeah. Or the knowledge.
I think your money will always be better, even if it's on listed companies with sustainable.
But it feels to me like there's a kind of a graduation of steps here, right?
There's a continuum of impact. Totally.
Right. Thank you. That's a much better way of describing what I just described poorly.
Yeah, we have to think about the spectrum, right? All the way to the left, you have negative screening, just removing the bad stuff.
Right.
Gambling, tobacco, great. You are absolutely not saving the world, but you are, I guess, not making it worse. And then, ethical investing and starts, when you start to have a bit of intentionality into what you invest in. And impact investing is all the way to the right, where you deliberately try to add something to the table and create an impact. And all the way to the right, there's just after impact investing, you have philanthropy, which is where you give money without an expectation of return.
Right. There's a whole other question and probably podcast around whether that actually has a bigger impact at a macro level. So I'm going to park that, even though I do want to talk about that. But what I want to get back to is this continuum of impact. Is that what you call it?
Mm-hmm. Yeah.
And I guess related to that point, as a person who thinks about optimization a lot, right, I'm always thinking about, well, I could do this, but if I did this, the impact would be greater or the usage would be lower, depending on what we're optimizing for. And this kind of gets me onto the segue of why now and why Bloom, which I want to go into a lot of detail on. Is there a gap here that's starting to move into actively funding the things that need to be funded, as opposed to funding the companies who will then make decisions at least aligned with your values and ultimately funding the things that need to be funded? Are we kind of shortcutting the process by saying, actually, there's projects now that will move now if you fund them now, and we don't need to go and, I'm trying to work out if the impact's greater and where you guys sit in enabling people to actually invest in projects rather than companies who will then do projects.
I'm trying to unpack your question.
Do you want me to repeat it?
Yes, I think that would be helpful.
Okay, so let's say
one specific
one
layer
specific
of your
part.
question.
Yeah. Sorry, I tend to do this. So, I guess where I'm going, and let's keep using the Future Super example we've got, right? I can put my super with Future Super, and I can give them the 32 grand, and then I can trust them to go in, put that money into the Sims of the world and the clean ways of the world, and potentially go and buy a solar farm. Or I can put the 32 straight into a shovel-ready wind farm. Am I enabling the system to move to impact faster and better by doing that type of decision to invest in?
I see. Okay, so actually we're talking here about the different management layers between an individual and the money, I guess. I think in Australia anyway, given the regulations in place to protect retail investors, there will always be layers unless you do crowdfunding.
Right.
You want to have a direct, impactful impact onto something. Crowdfunding is the most direct route, or a donation, like you said, because your money doesn't really have an intermediary and it goes straight to the project or thing you want to fund. I wouldn't say that having a management layer is something that breaks or something that slows down the impact. I think a manager is here to efficiently manage the money. And if you were to go alone, you wouldn't have the impact you want to make because you're too small.
Right.
So this is where your money makes an impact at Future Super because it compounds.
Right.
Your 30 grand is actually in a pool of 10 trillion. Right. So this is where I think, and that's the role of managers. It's to pool people's money together and manage it wisely.
Mm-hmm. And then, but in terms of where Bloom sits in this kind of continuum of impact, it feels to me like Bloom is carving out a way of investing more directly into these projects.
Yes.
Through a manager, yourselves in this instance, but without having to kind of say, well, I'm going to go into a pool and I'm going to trust you to then invest in these things. I'm trying to understand if there's a difference in the velocity of the impact.
Yes.
Because the project's ready to go. They're just waiting for the 32 grand.
Yes. Okay. So that's a good question. So Bloom indeed is the first platform, to my knowledge, in Australia, allowing investors to invest little amounts into clean energy projects and infrastructure. But again, to comply with regulations, we had to wrap these investments within a fund structure. So I'm not going to go too technical, but your money is actually pooled with other investors and then invested into. But nevertheless, it is going to the actual project at the end of the line. So
and just to the follow-on part of that, does that mean that the money leads to impact, far away, or is it just trying to fill a gap in the investment kind of pool that perhaps, it's trying to attract capital into a particular investment class that otherwise isn't getting enough capital or bring more capital into? I'm trying to work out the lever at play here that a retail investor is either helping fill or augment, or is it simply that they feel better about having invested the 32 grand there because they have direct line of sight to the thing that it funded? I'm trying to work out both.
It's both. Right? It's both. I think it's important for two reasons. First, clean energy infrastructure has lots of benefits. And unfortunately, since before Bloom, it was often restricted to wealthy, sophisticated investors. I'm sure you already know, but for some listeners that might not know, a sophisticated investor has to have a 2.5 million net worth and often invest in tranches of 50,000 or more. So not everyone has this kind of money, right? Sure. And unfortunately, for a long time, you had to have these requirements before investing into infrastructure.
Right.
Bloom is here to democratize all of this and make it a lot simpler by allowing, possible by allowing people to invest in these wonderful things, starting from $500, and we'll actually lower this even further down the track. So I think the accessibility is really important, and the impact is also really important. Yeah. Because remember how we talked earlier about additionality? I think infrastructure, like you said, has a very clear, measurable impact. We know that this solar farm has had this amount of renewable energy output to the grid. And we know that, it has saved X amount of emissions compared to a fossil fuel equivalent way of creating energy. So I think it's a way for people to know exactly where their money is going. And again, owning and benefiting from the clean energy transition.
Yeah, absolutely. And just interestingly, I'm kind of wanted, there's quite a few questions here, obviously, but just in terms of it as an investment class, this is, I mean, we talked about impact investing, but this is investing, right? It's an asset class that performs well. Like, is it typically something where someone said, well, I could put 32,000, which may not be all my super, into cash and get 2.5%, or I can put it into this wind farm and I know I've got 20 years of being paid an equivalent return of that order of magnitude. Like, help me understand where it sits as an investable
Where it sits,
asset.
absolutely. Yeah. So typically infrastructure sits, in our fund, and I'm going to speak with some precautions here because I'm not an absolute expert. I'm also learning a lot in this space. But in our portfolio, infrastructure sits in the defensive asset allocation, meaning we are not targeting growth outcomes, but still a very healthy return profile. So just to give you an idea, 4 all the way to 12 is possible in infrastructure, depending on the assets and depending on the manager and all sorts of things. So I think it is a good asset to have amongst a diversified strategy, like any asset, really. You want to have a little bit of everything. And I think it's a great way to diversify your portfolio and future-proof your portfolio against climate risk, which is another can of worms that we can open now.
We have plenty of time. Just I want to get back to the kind of where it sits in the defensive class. So if we think about cash as an example, or bonds or these types of things that typically sit in that investment class, a lot of it sits in that class because there is typically you're aligned to government risk, right, in terms of what the cash rate is or what the bond rate is or, the credit rating of a particular country, assuming Australia in this case. What role is policy playing in providing some degree of surety to price that these assets can generate or the return these assets can generate? And is that why it sits there or is it something else?
Yes, totally. So I think there's 2 aspects. So it's defensive because it's less correlated to markets movements.
Right.
It's often correlated to electricity markets.
Right.
And indeed, electricity markets are highly influenced by policy and also the greater, energy
Context.
system. So there is some sort of predictability in this space, because that, X amount of megawatts will be sold by X amount. Also, sometimes clean energy providers have some contracts in place. So PPAs, which is power purchase agreements, which sort of like guarantees a certain price for a period of time. So it's not as volatile as let's say, a GameStop stock. Or
I love that we're still picking on GameStop.
You know what I mean, like or cryptography. Let's use an extreme example.
Pretty sure GameStop was more extreme than crypto, by the way. Okay, so there's some degree of also. This is infrastructure, right? This is kind of like banking and roads. These things are there as long as there's populations there. As long as there's economies there.
There's always a risk. So you could have a risk of a solar farm is built and then not connected properly to the grid, or maybe the community doesn't want it. So this is at the project manager level that the risk needs to be managed.
And then I want to follow on from that. And then with the way Bloom sits inside of that is, hey, here are the projects we're investing in, buy into the fund and we will invest in these projects. So there's some inherent diversity in that approach anyway. So it's not like a one-to-one. I only want to put it in that tenant farm, solar farm or how?
Absolutely. So we are too small to own our projects, meaning Bloom is not directly investing in these projects. We're too small. I really hope that one day we'll get there. This is the plan. For now, we trust managers. And I think this is important because we work with retail investors. We offer a 3 to 5 days liquidity, meaning someone can invest in Bloom and get their money back 3 to 5 days later. I think this is very important for the retail investor. And as such, we do invest in infrastructure through other managers, through other funds but it doesn't mean that we compromise on the impact and the projects we invest in. It just means that it goes through other funds and we have trusted managers that have the size, the knowledge, the track record of managing projects properly.
Right. And they're the actual project managers who are essentially saying, we need a pool of capital, and you're now one of the pools of capital, and pointless for you to go out and attract the capital and try to run these projects. For now,
That's
it's
right.
about attract the retail investor. Yeah.
Yeah, clean energy is interesting. There's often the project originator. Mm-hmm. There's the project financier. Yeah. I'm not sure how to pronounce this.
No, perfect.
And then there's
sounds better the way you say it.
And then there's the project manager. Some fund managers do everything from start to finish. So I will give you an example. Octopus is one of them, just a huge investment manager in this space from the UK, who also has an arm in Australia that we are actually considering at the moment. Mm-hmm. Another one is Palisade. Mm-hmm. It has a great infrastructure fund, and they don't do the origination, but they do the finance. So it's all about working with the partners that are good at what they do. Should it be, managing the project or financing the project? It's a different skill set.
And just, again, it's kind of a tangential question, but these managers who are also doing the financing, I don't know how you said it, but it was fun. What's stopping them, or what has stopped them from trying to do a direct to retail customer offer? They're just like, that's just out of our wheelhouse. Like, is this a partnership structure for you? Like, how does that?
That's a great question, because when I started Bloom, I was like, why can't I invest in these things? Because I started the journey as an individual, and I was like, I want to invest my money in a solar farm. Where can I go? And there was
to your roof, apparently.
Exactly. There was either I could put solar on my roof, or I could invest my money through my super.
Right.
And pick a super that would support but there was nothing outside super. And this is because of regulations. Right. So infrastructure investments are typically illiquid. So they are not well suited they are kind of risky for retail investors. Retail investors typically need to get their money in and out of an investment scheme quickly. So this is the barrier. Right. And the way Bloom has gotten around this is by blending different types of investments throughout the full spectrum of asset classes, so that investors could access this asset class. But they do access it because it's blended amongst other things like solar loans, fixed interests, green bonds, but also stocks. So also listed companies in the climate space.
Got it. So what you essentially do is say, look, we've got, and to be fair, you just saying you're small, by the way. At time of recording, I think you've been around for 6 weeks in terms of live. Is that right? About 2 months?
Yeah, that's right.
And you've attracted $1 million worth of investment already. I think you're doing fine.
That's right.
I know you want 3 extra zeros on that, but just to give credit.
We need to move billions into
I know. So you want 3 extra zeros or 4 extra zeros, I guess. I just wanted to come back to that point because you said we're small. I'm like, give yourself some credit. I've literally been live for not even 2 months. But I think what's interesting, I just want to unpack that, because what I think is happening is similar to what happens in a bank structure, which is you never expect everyone to all want to withdraw as retail investors at any given time. So you take a blended approach so that you've got a bunch of stuff sitting in longer term, longer maturity stuff, and you've got a bunch of smaller things that you literally could liquidate tomorrow if you needed to. And there's a certain pool of people who might need to pull out some of their money tomorrow, and therefore in 3 to 5 days you meet this as a requirement. It was going to be kind of my question is there a part of this where, and you mentioned self-managed super funds right up front, is there a thought here that a lot of the self-managed super funds have a longer-term horizon, and it makes it easier for you to attract the capital that's going to go into these longer-term horizons, solve some of that horizon maturity challenge? Is that part of it?
Yes, absolutely.
Have I read that between the lines?
No, it's very true. Look, Bloom is all about, we're not a trading platform, we're an investment product, which is very different. Investing for the long term. So our time horizon typically will be around 7 years. So we're hoping people can stay with us for a long time. Yep. And why wouldn't you when you invest for climate impact anyway? I think people can understand that if you want to support climate impact, it's not going to be like a quick, make a buck and then move on. It just doesn't really work this way. It's long-term investing and returns over the long term. Where were we going with this?
For me, the maturity thing is quite interesting because it relates to a distribution challenge as well. Yeah.
Yes, it's super bonds.
Okay.
Yeah, I
back?
didn't expect. Yeah, that's right. So thank you. I found my way back to my thoughts. It's the way, right? When you discuss big ideas, you sometimes get lost in your head.
Yeah, this is what I told you. We'd be doing rabbit holes. That's why we're here.
So self-managed super funds, it's a funny one because I did not expect Bloom to attract such a customer profile, but we have. And in fact, I didn't know how big the market was before a few super funds started signing up for Bloom. So I think it's a wonderful opportunity. And I've also noticed that all this data is available for everyone to look at. I've noticed that predominantly these customers typically invest in a few stocks and in cash, and of course a lot of property because Australia, but that's property not really well diversified. You'll have some people who have almost the entirety of their self-managed super funds in cash and they do nothing with it. And I'm like, wow, what an opportunity here. Yeah. Both for people and for the planet.
Yeah, I think what your argument here is that these are defensive assets and they're not cash assets. So there is an investment risk with them, but in a diversified, unless you believe that the macro for a shift to energy related investment opportunities is going backwards, which I don't think anyone believes. I think there's so much policy support for the shift to, then you're only aligned to trend. You're not swimming upstream on this thing.
I will go a step further and say that people who do not prepare their portfolio for the transition are exposed to an incredible amount of risk. And I think a lot of people about to retire in Australia do not realize this. I'll just give you a mind-blowing figure just to make my point. The Association of Superannuation Funds, so the ASFA, estimates that 10% of the total economic value of super could be lost by 2050 if climate change continues at its current rate.
Just impacted by being exposed to the wrong things, I guess. Yeah.
Absolutely. Well, when we think about it, Australia's wealth has been built on mining.
Natural resources.
The world is already changing. Things are moving. Europe is shifting. And where will our super be left if we keep it in the businesses and technologies that will no longer be relevant in not even 5 to 10 years? It's going to happen really quick. I think some people don't realize how quickly this is happening.
And I want to dive in and I want to challenge you on a little bit of this because I think there's an energy problem, as in like there's an investment opportunity, right? So I'm going to put that close. But then there's a sort of a step removed from that. I'm going to name a company just because I need an example. So I look at like someone like Fortescue, right? So Fortescue has a bunch of energy that they use. Yep. Fortescue FMG. Yep. Full disclosure, I'm a small investor in Fortescue, but I'm an investor in them because I think they're a large infrastructure player who has pulled stuff out of the ground and is going to work out how to build stuff, and they just have the right kind of set of credentials. But I guess the thing I'm trying to understand is if I think about Australia's exposure to this, our energy exposure is we have massive gas reserve. I think we're the second largest exporter of gas globally, either second or third after Qatar. And this stuff will, in the near term, 10 years, maybe 5 years, maybe 15, become largely relevant as there's an electrification. But I'm just trying to think about Australia generally. What do you like? Is Australia's exposure to decarbonisation and the move to electrification in a direct sense, not in an environmental sense or in financial sense, heavily impacted by this shift, or is Australia relatively well set up?
I don't think we're taking the full potential of the transition, that's for sure. And I would go as far as we're not really well prepared. I mean, I'm not an economist. I'm not an absolute specialist to talk about this, but I can certainly say that a lot of companies on the ASX are absolutely not aligned with the Paris Agreement. And that's just a climate risk. It's a financial risk. They have ESG risks, and we know that weak ESG credentials lead to underperformance financially. There's like studies after studies making this point. So totally. And I think the problem here is, will Australia rise up to the opportunity of using the incredible resources that we have to become by the way, this might all sound weird with a strong French accent, but anyways.
You just keep saying we, just the we Australians. Yeah, I got it.
Well, I feel very much part of this country, but yeah.
I love that. I
mean, Australia could be a superpower, a clean energy superpower, create thousands and thousands of jobs in the process, or the transition will come from other places.
Yeah.
And, new minerals or new technologies will be provided by other players like, China or even Europe.
Yeah.
It's a race in a way.
Yeah. And look, it's interesting that you phrase it in those terms, because I think, we tend to think about, well, especially in our superannuation, right? We think of it as a defensive asset where you don't want to introduce too much risk. But you're sort of framing this the other way, which is to say that there's a whole bunch of potential projects and revenue and investment opportunity, and you're missing out on an investment opportunity. And by the way, it sits in the defensive class. If you're not allocating to this asset opportunity, not only are you slowing down the opportunity for this particular country, but any country, depending on where you are, but here because of Bloom, to be able to participate, you're actually also missing out on an investment opportunity. So it's kind of a shoe on the other foot. I want to come back to something though that kind of you spoke about before. You said you were surprised when you started getting self-managed super funds come through the door. And I kind of want to turn this into the challenge in now for Bloom. Zero to a million in under 2 months feels amazing as a starting point for you. But what's the real the block here to add another 1 or 2 zeros to the end of that? How do you think, how's Bloom as an investment class going to get into the hands of 880 billion worth of super funds? Self-managed super funds.
Yeah. Well, that's a great question. I'm trying to solve every day. But I think one of the biggest challenges is customer growth. So acquiring customers in the financial space, and I think you would know this more than anyone, is costly, is difficult. It takes a long time. You need to build a brand. You need to build trust. I think it's funny because my background, I spent a lot of time in digital marketing and e-commerce, and it was a lot easier to sell a pair of earrings than selling a financial product. And it's normal, right? Because people, A, don't want to think about their finance, and B, there's a lot of emotion around money. And this can be very daunting and overwhelming and anxiety inducing. So we're talking about selling, a product that is scary to people anyway. I don't think it's scary. I think it's very exciting, but a lot of people think it's daunting or exciting. So I think the only way Bloom can make a true dent in the market is by making, and this is our mission, making impact investing easy, accessible, financially rewarding, and the sexiest thing on the planet.
Sexy, okay. I love that. Again, you're right. I mean, acquiring customers in any financial services context is tough, if nothing because of the inertia, right, of people to make decisions. Their money is already here and you're asking them to do something. And I mean, even when I deal with Wealth Crew from Shaw, the amount of forms I have to fill out just to change my address on something, let alone to change the investment class I'm dealing with, it's incredibly frustrating. Partially systems, partially policy. I think the thing that I'm asking about here, though, is how many people are operating in a bubble with regards to, even if they are a self-managed super fund, their self-managed super is still being done in concert with advisors and people they trust. I'm trying to understand where the investment class sits in the advisory class world and what role and how that's going to play.
Yeah, that's right. You're unpacking my full market discovery here. So there's 2 types of self-managed super funds from what I can gather. And again, I'm new to discovering this space. I believe there is part of them managed by advisors.
Right.
So you then enter a world of intermediaries, and this is the upper bracket of the self-managed super funds. Typically people who have $200,000 upwards to, millions in their self-managed super funds.
Yep.
And then you have a self-directed band of the market. And these guys manage their own wealth because they want to, or they know how to, and they want to pick things the way they wish. Now, what's interesting is I think things are changing, and young investors love to do their own thing. And they don't necessarily want to go through advisors. Right. And they are about to inherit incredible wealth from their parents' baby boomers. So the question becomes, how do we tap into this wealth transfer and catalyze this for impact?
Yeah.
That's a fun question. So I think the battle for wealth at the moment is who will capture the hearts and minds of millennials.
Yeah.
And Gen X and Gen Z.
Hence your comment before about making it all of the things and also sexy. Yeah.
It needs to be easy, engaging. It needs to
Rewarding.
be simple, rewarding. We essentially need to apply the best learnings and technology experiences from the retail market. And when I say retail market, I mean, booking a taxi, Uber, booking an Uber, ordering something on Amazon. How can we apply this to wealth management? Is my goal with Bloom. I think this is how we can win.
Yeah, this is really, really interesting. I think there's probably a lot more that we have to unpack there, but I want to ask a few more questions about how you go from selling earrings to building Bloom. What's the arc of this story generally as to how you're here? When you and I, to be fair, you and I met probably earlier this year, or even late last year. We had a chat before Bloom was ready for prime time. So you've been at this for a short while.
For a little while.
A short while, I'd say, in the grand scheme of things. A long time in millennial years, but a short time by anyone else.
That's right. We're so impatient, aren't we?
So, by the way, I have this theory that everyone's a millennial. You know what I mean? Like, all of the things that we don't judge for millennials have been. You go and look at old photos and there's everyone on the bus reading the newspaper and not talking to anyone. Like this, everyone's a millennial. We just like to point at them and say they're millennials.
Yes.
But coming back, how have you arrived as an Australian in here to do all this? And give me all that. I want to know.
Okay. Well, the long story short, there's been a bit of a crisis in the middle, but let's backtrack. So indeed, I grew up in France, in the French Alps. So I was always very sensitive with nature. I grew up skiing, mountaineering, so really close to nature. But, when I was a kid, climate change wasn't really a thing. All we cared about is not throwing our rubbish on the floor. Right. Yeah. We could change a few light bulbs and job was done. So I started my career, all that to say, I've started my career having a strong interest in sustainability and just doing the right thing, but not thinking that I had to work in this space to make a difference.
Right.
So for 10 years, I worked in the digital marketing and e-commerce space, which was, a great experience to, just learn business and marketing and all of these wonderful things. But in 2018, I read the 5th IPCC report, so the biggest scientific report on climate change. And this really, it sounds exaggerated, but this report changed my life.
Yeah.
I remember that morning reading the findings and crying and really feeling in my bones the existential threat of climate change. I know this sounds heavy and a lot, but this is really what happened to me in that moment. And a week later, I quit my job and I decided that I was going to dedicate my career and my life to climate action. And I didn't really know how back then, but I thought, if I'm clear, I will find a way. If I'm clear on the why, the way will appear.
Yeah.
And it did. I joined, in several steps. I didn't create Bloom straight away. I joined Energy Lab, which is a clean tech accelerator, one of the leading clean tech accelerator organization.
Were you already in Australia at this point?
Yes.
Yeah. Okay. So you'd come to Australia off the Alps, recycling, and then 2018 IPCC report in Australia.
That's right.
And now Energy Labs.
Yeah, I had already worked a few years in e-commerce and retail in Australia before I made the shift. Yeah, absolutely.
Sure.
Then I had 2 years to learn a lot about. So when I joined Energy Lab, I was thinking that we had to create new technologies to solve climate change, naively.
Right.
And I quickly discovered that we had almost all the solutions available already. And all we needed to do is to just get it done and move forward with the solutions we already had.
Sure.
And I became fascinated with the huge shift from fossil fuel to clean energy and what that was going to transform in our world. Because when you think about it, energy underpins everything in our economy, right?
Right. Yep.
So when
you can
shift,
pretty much do everything. Yeah.
Exactly. And we can see it now. The price of oil impacts everything in our lives. So I think this is just a tasting of how much energy can impact our lives.
Yeah.
And so just really became fascinating by the opportunity and wanted to start investing my own savings into clean energy and innovative clean tech companies and couldn't, because I was not a wealthy sophisticated investor.
Yeah.
I didn't have 50K to invest in, all at once.
Yeah.
And this is
$2.5 million.
I didn't have $2.5 million in net wealth, unfortunately. And I thought, well, there's a bit of a gap here. Why isn't there anything to help people like me invest in something that makes so much sense and could have such a big impact?
And there's something fascinating about that, because all of the backstory leads you to the why, as you said, but the actual solution itself only became evident in you trying to take direct action rather than trying to build a solution that you needed to exist. You've kind of said, I have no idea how to build this. I know that I want to do it. And if I want to do it, then there's probably others who want to do it as well.
I was not really, it's a funny story. I was not happy to find out that
there wasn't an option.
I had to work in finance. No, but I will be honest. I mean, I'm fascinated by it. I think it's an exciting, wonderful space to work in, but that was not my background. It was a steep learning curve. It's true. The most highly regulated environment, and I had to create a startup in it. Get out. It was the worst. It's true.
It goes
right?
against my grain of who I think I am.
It's not, I didn't have a problem with, going into, I just mean by this that, finance is such a hard environment to innovate in.
I think yes and no. Sorry.
Yeah. I mean, for someone who doesn't have a background in it, it was a steep learning curve.
Yeah. Look, I think the thing that it's interesting that you think of this as a finance company, or a finance startup or a fintech. I don't love the word, but there we are. But I think your point still resonates here, which is there is a financial product, which is the thing that delivers. But the thing that actually makes this successful is the desirability and the attractiveness and the customer experience. And these are all the things that were part of the backstory and how you came to it. And I think if you kind of create a financial services company and brand that is, attractive and relatable and enticing and engaging and sexy, I think you used the word earlier, then that's the kind of company you want to build, even if it is in financial services.
Yeah, it's very true. It's very true, because at the end of the day, it's about building customer happiness and loyalty.
Absolutely. Yeah, I think your e-commerce background will serve you well. Just in terms of, probably as a last question from me, but from where to from here? What's the big enemy at the gate? What's the next major hill to be taken for you guys for Bloom? What's that?
It's reaching a certain scale. So I guess wealth management only works at a certain scale. You have to have a certain amount of customers and funds under management to survive and make a good impact.
Yep.
So I guess our biggest challenge and biggest hill is how fast and how efficiently can we get there whilst making our customers really happy. I think that's the real challenge here.
Yeah, beautiful. Well, I have no doubt that we'll be following your journey. So I'm sure you'll be solving it. I look forward to our check-in on the numbers in due course. Maybe with another 1 or 2 zeros on the end of it.
I hope so. Let's catch up again in a year and see where we are.
Perfect. Thank you so much for being on the show today.
Thank you.
We hope you enjoyed this episode of Shape the System. As usual, if you'd like to suggest a guest, someone that you know who's helped change a system for the better, please go to www.shapethesystem.org, click on the top right-hand corner, then click Suggest Guest. Make sure that you click subscribe so that you get the new episode. Shape the System is an independent podcast with support from KPMG High Growth Ventures. Connects founders to the services they need along their journey. Whether you are looking to refine your strategy, mature your finance function, prepare for a capital raise, expand abroad, or simply comply with regulatory requirements, they provide you with the support you need to drive your business forward.